Still waiting to see. There we
Oh,
are.
there we
Okay,
go.
we are live. So welcome everybody out in the Endgame audience. It's really great to be with you here live. Thank you all so much for your enthusiastic response. We had, quite frankly, a much bigger response than we anticipated. So I guess we struck a chord here. And one of the people that we interviewed during the Endgame series that we got an extraordinary amount of feedback on, who definitely was a favorite out there, was George Gammon. So I reached out and said, hey, can we do something live for this audience? And George being the busy, I mean, you can tell our back, we're both in hotels right now.
Yeah,
So,
right.
yeah, so George, busy guy, a lot going on, but he said yes enthusiastically. So let me just say, George, thanks so much for taking the time to be with us here.
Thanks for having me. It's always fun to talk. I'm really glad the Endgame docuseries went well. I was a huge fan, and I'm glad to see other people really liked it.
Yeah, it's like the momentum was really strong, and what's unusual, I mean, yeah, we've done several docu-series, is how big the audience continued to build day 2, day 3, day 4.
Yeah,
We kept
yeah.
seeing the numbers go up, so obviously people were talking to their friends because of the information. And I'll tell you, since we've made the series, still more stuff going on that makes us even
Yeah.
more nervous about what's going on in the world. So, what's top of mind for you right now, George?
Well, I can't remember what we talked about on the docu-series. I don't want to be too redundant, but tomorrow I'm speaking at the Money Show, and I'm doing a presentation on inflation, and I think that's kind of a hot topic right now because uh, the Fed and the mainstream media is saying that inflation is going to be transitory, is the word they're using. And so everyone's seeing the prices that they're paying at the grocery store, and pretty much for hotel rooms, for cars, used cars are up huge. Oil's what, $70 or so per gallon, right? Or
Yeah.
per barrel right now. And so they see asset prices, every single day you look at the stock market, it's at an all-time high. Housing prices at all-time highs. And I think it's quite disingenuous that they kind of exclude asset prices from the rate of inflation because in our economy, unfortunately, we live in this not just debt-based economy, but economy that's built around asset prices and asset bubbles.
Mhm.
So to get ahead, if you will, in an environment where we're getting 2, 3, 4, 5, 6, 7% compounded rates of inflation, you can't just park your money in the bank. You got a negative interest rate. So you've got to go into the stock market. You've got to have assets. You got to own something, or else you're going to be losing that purchasing power. And it is great for some people if the stock market's at an all-time high every day. But for those who don't own assets, that's a big problem.
Yeah.
And that's where we get that wealth divide and the wealth gap. And I'm sure we probably discussed that in the Endgame series, but it's worth noting that the Fed and the government have painted themselves into a corner where the only thing they can do is exacerbate the problem because they've got to continue with quantitative easing. They have to continue with the stimulus and the deficit spending that's monetized by the Fed. And I think eventually they're going to get into a central bank digital currency because the Federal Reserve realizes that they're not in control of the dollar. And that's the commercial banking system. It has been for decades. And now it's kind of this weird hybrid system with the government. And that's why we saw M2 money supply go up so significantly in 2020, because actually commercial bank lending went down in 2020. So if the system had stayed the same, the amount of dollars in the system would have actually gone down. But we saw a 25% increase, and that's because of the deficit spending by the government that was monetized by the Fed. Usually, when they deficit spend, of course, they would sell bonds to do that, and that money would come out of the economy because entities and individuals are buying those bonds. But this time, they don't do that when the Fed monetizes it. So I think that in the future, they're going to have to bail out the government with sustained inflation, even if what we're seeing right now is transitory, because the government is the largest debtor nation in human history. And the way that you get out of debt or you reduce the debt to GDP is through inflation. You just pay it back with cheaper dollars. And if they could fabricate something like the 1970s, that would get the debt to GDP down to a much more manageable level. Unfortunately, that's bad for the economy. That's bad for the standard of living. That's bad for the average Joe and Jane. And then, of course, it's bad for social unrest and civil unrest, which is part of what you discussed in the Endgame series quite extensively. So that's kind of what I'm trying to think through. It's like, what is the system going to look like in 2 or 3 years? And if we can try to predict what the system is going to be, then I think we can get a much better handle on the probability of inflation being transitory or not transitory.
One of the things that has become really clear through this experience with Endgame, and you basically just cited it, is that it used to be that we'd look at your financial investments and so on. Like we've done Money Revealed, Wealth Breakthroughs. We've made docuseries on that whole arena, as its sort of own subject. But now, and then we've talked about things, in preparation and so on, as far as getting your house in order and all the kind of supplies you might want to need and what kind of things can happen, et cetera. Now these two things seem to be completely entangled. That preparation, really, the mindset for it is not just, well, how can I prep my investments and my wealth, whatever level that might be, for what's going on in the world, versus this other thing over here, which is maybe personal and family preparation. Now they're kind of all together, and like seeing that these two things relate to civil unrest, financial issue. These things all kind of are entangled.
That's right.
And trying to separate them, you're not seeing the big picture. You mentioned the wealth gap, which, as the wealth gap grows, that's going to lead to, the higher probability of civil unrest and things happening. We talked about, with civil unrest. Okay, well, what happens if certain things go bad? Because some of these can be triggered maybe by a financial event that triggers maybe other events, or we might have some sort of civil unrest that triggers financial meltdown. So the two things seem to directly relate to each other, and I think people are starting to become more aware of that now. One of the things, I was talking just recently, maybe about a week and a half ago, to a really good friend of mine out in Park City, who is an economist. He was an economic advisor to Reagan, to the first Bush administration. He's written books, and we have these pretty intense discussions, because his whole thing is, servicing the debt's no big deal. We got over $130 trillion in net assets, as far as what's the worth of America. And I said, yeah, well, what's the distribution of that wealth?
30 trillion. Well, where's he getting that number?
Basically, if you take all the households of the United States and look at their net worth and combine it, it adds up to, I think, $130 trillion. I said, well, how much of that is land, which could go, which could devalue over time? How much of that is, savings? But the problem, as he cited, is that, and let's say, I didn't ask him to validate the number, but he did cite it. I don't remember what it was, but so I said, because is it true that most people? I mean, I've seen it. You've probably seen it too. That most people, the vast majority of people, couldn't handle a $500 auto repair right now, right? There's but so he said yes, but the people who have assets have very big assets, and he starts citing the wealth divide, which I think is a big problem. But the point, go ahead. Do you have something to say about that before I?
Yeah, I mean, that's on their balance sheet, though. That's not on the government's balance sheet. That's not an asset of the government. That's that's an asset of the private individuals. Now think about it. Where I don't know if his thing right? is, well, they can just tax it 100% and just tax everything and just steal it. Okay, yeah, well, but I don't know if that's a realistic solution.
Well, this is.
I mean,
this is really interesting.
It's kind of
good.
It goes back to probabilities. Let's just assume that the government said, okay, we have to pay down our debt. We can't do it through inflation, so we've got to do it through explicit outright confiscation. So we're going to go ahead and jack the tax rate. We're going to create a wealth tax, right? And it's going to be, call it 50% on, or it's going to be 80% on individuals that have assets of over $1 million. Yeah, good luck with that. Good luck with
Yeah.
that.
Yeah. Well,
You
and
think
that's
people
the
are just going
idea.
to write you the check for 99% of their net worth? No, of course not. So that's something that, okay, fine. It looks great on an Excel spreadsheet, but in the real world, the probability of pulling that off is just slim to none, in my opinion.
Yeah. Well, so and that's exactly it. It's I think with the incurring putting in. He said basically, listen, and I'm just laying this out because and incidentally I was disagreeing with him and we're debating this in a very collegial way. But basically, the idea is saying, hey, all that wealth, if you don't somehow take care of the situation, and you have all this many people who are really upset and just few people who are trying to live up in their their castles on the hill, these people should want to pay some some of their wealth to keep things at peace in this country as compared to having the whole thing disintegrate. Which, so I said, putting the moral issue aside, and the moral issue is a big deal as far as you're saying, stealing this or confiscating this wealth, and I think he was talking about like a 1% wealth tax or something. And I said, well, what about liquidity? So I got in that whole thing. So a lot of people have wealth, but it's not liquid, and what they'd have to do or sell to be able to pay this wealth, could create all kinds of other upheavals.
Yeah, I think you need to have me on to debate this guy
Yeah, I will.
in a respectful fashion, because what I would do is point out the fact that he's making some serious flaws, in my opinion, as far as the assumptions, and he's assuming that government spends money well, number one, and he's not understanding that usually when government spends money, let's look at what they did in 2020. That was, let's say, keeping the natives calm by sending out all these stimulus checks. And I would guess that he thought that was probably a good idea, because you want to make sure that people have food to put on the table and whatnot. And maybe short term, okay, I get it. But let's look at the fact that now the entire economy is addicted to it, and the rates of income are 20% higher in 2021 than they were in 2019 prior to this. And then I would ask, okay, what is wealth? Right? See, he's looking at it from the standpoint that wealth is dollars, right? So just the more dollars you have in your account, the wealthier you are. But I would say, okay, if you're on a deserted island and you've got a chest full of $1 billion, are you wealthy?
Yeah,
no,
exactly.
You're not. So the point is, what the government is doing and what the government would do by a 1% wealth tax or a 50% wealth tax or whatever. He thinks that the government is just this benevolent dictator that's just going to take, like Robin Hood or something. It's just going to take from these rich people and it's going to give it to the poor. We're going to kind of even things out and everything is going to be hunky-dory. We're all going to sing Kumbaya. What he doesn't understand is that's going to distort the economy. That's going to create more malinvestment, more misallocations of resources than we already have, and we're not allowing the system to reset and get all that out of the current economic system that has created so many of these problems. And to boil it down to its simple, a very simple level, you just have to ask yourself, okay, is creating a wealth tax, is that in the future, is that going to create a system where we're producing more goods and services or fewer goods and services? By allowing the government to take control over private sector resources and distribute it in a highly inefficient manner, is that going to allow the economy to produce more goods and services in the future? The answer is obviously no, that will produce fewer goods and services in the future as a result. And if you define wealth by the amount of goods and services an economy can create efficiently, then by definition, by doing what he is suggesting, over the long run, our entire society will become poorer.
Yeah. And I think that's an inescapable conclusion. And that's a big part of what I talked about. I said, creating dollars with no, I said, because we look at GDP and saying, just create a bunch of dollars, and there's nothing of value that is reflecting those dollars or representative of those dollars, what are you really doing? And I said, and I think he does believe that as a short-term solution, the quote unquote bailout. He said otherwise it could have been years of recovery as compared to a faster recovery. He had a whole thought around that.
Yeah, but see, even the terminology he's using, recovery. What are you talking about? Recovery. We haven't recovered anything. The only thing that's recovered is nominal GDP. That doesn't mean that the quality of the standard of living has increased. That doesn't mean the true wealth of the society has increased. Basically, what we've done is we've taken a 150-pound scrawny dude and we've loaded him up on steroids. Okay, and then he goes off the juice for a few months, and he goes from, let's say, 250 pounds, just nothing but steroid muscle, right? Then he goes from 250 pounds down to, let's say, 200 pounds, and his normal weight should be 150. And then we say, oh my gosh, he's coming down here. We got to give him more of the juice, more steroids, more steroids, more steroids. And you know that those steroids are making him fundamentally more unhealthy. But yet his weight gets back up to 230, 240 pounds. And then we say, oh, whew, my goodness gracious. Wow. Thank goodness that he's recovered. What do you mean he's recovered? He hasn't recovered anything because he's more unhealthy than he was at 200 pounds to begin with, right? So we haven't recovered. It's the same thing with the housing market. That's one thing that really was my pet peeve over 2000, call it 16, 17, 18. When I say the housing market has recovered, again, it hasn't recovered anything. When you look at where we bottomed out in 2012, that was our historic trend line adjusted for inflation going all the way back to 1900. 1900. So when we were at the price level that we saw in 2012, those were real prices. That's when we had true price discovery in the housing market. Now we haven't recovered the prices that we had in 2006. We've just inflated another giant bubble that's just going to come crashing down. So I really have a problem with that word recovery when we're dealing with an underlying asset bubble, or we're dealing with an economy that is so structurally unsound.
Yeah, and I think for good reason. There is that concern. What do you think the role of artificially low interest rates are in creating that bubble?
Well, it does the exact same thing. It creates economic distortions. You got to think about it this way. Money, or let's say dollars in the United States, are 1/2 of every transaction. Every transaction involves dollars. You're at a hotel room. You had to give dollars for that. I'm in a hotel room. Same thing. You had lunch today. We're YouTube is paying advertising. It's always dollars for these transactions. Okay. Well, what's an interest rate? An interest rate is the price of money. So if you are artificially manipulating the interest rates, you're artificially manipulating every single price in the entire economy. And what did price controls do in the 1970s? A lot of bad things. Yeah. A lot of bad things. So if economists can agree, pretty much Keynesian, Austrians, monetarists, all of them can agree that price controls are bad. Well, how is it that allowing the Fed to control the price of money itself is good?
Yeah. And I think they're painted in a corner, right? I mean, and this is another thing about the debt service that, is easily affordable. We're, $20 trillion economy, whatever it is. And the debt service is $600 billion a year. What's the big deal? I said, what happens if interest rates go up? Oh, that'll be a problem.
But not only what happens if interest rates go up. Let's rewind a little bit here. Yeah. Let's start and go back to quantitative easing. Okay, quantitative easing. We got QE1. Remember, that was supposed to be just a one-off extreme measure for extreme times, right? Well, then we got QE2, we get QE3, we get QE4, now we're on QE infinity. Now the Fed in this recovery. The economy's recovered, but yet somehow the Fed still needs to do 120 billion worth of QE every single month. Is that a recovery? I don't think so. So my point is we've built this new economy around the need for ever increasing amounts of monetary heroin. So first it was base money with QE, and we've seen that. We've seen it right in front of our eyes. They tried to reduce the size of the Fed's balance sheet, and the whole thing blows up, right? So Powell has to come right back out and immediately, not immediately, but he has to reverse course, and he's got to stop selling the assets, and he's got to start QE again. He's got to drop interest rates low. Okay, so it's pretty darn obvious that we can never get out of this QE game that we're in. It's this hamster wheel that we can never, ever, ever get off, because as soon as they try to pull away that QE, we're done. That's I think pretty much everyone would agree on that. But now what we've done is we've turned it into stimulus. So the same thing that they did with QE, they're now doing with stimulus, because the effect of quantitative easing kind of ran its course. It's like kind of pushing on a rope. It's just like that heroin addict, they need ever increasing amounts of the drug. So now we're filling that, we're getting that addict high through not only QE, but stimulus. And I think it's going to be the same thing. They start with a $5 trillion, they're going to start with stimulus 1, then it's going to be 2, then 3, then 4, then 5, then it's going to be stimulus infinity. And who knows, what type of financial monetary engineering we get after that. But the bottom line is it goes back to those distortions of the economy. Did you know that right now government spending is about 60% of GDP? 60%. And we all know how inefficient government spending is. Well, okay, assuming that they've painted themselves into a corner, like you were saying, and that they have to continue with quantitative easing, more importantly, they have to continue with these this deficit spending. What does the economy look like when government spending is 80% of GDP? And let's just think, if nominal GDP doesn't go up in relationship to the amount of government spending, that means that the private sector, as far as their percentage of GDP, economic output, is going down. Right? So you got the private sector shrinking and the government increasing. And last time I checked, communist Russia and a centrally planned economy where government spending is 100% of GDP, it didn't work very well. And there wasn't a lot of wealth. Now, there might have been a lot of rubles, but there wasn't a lot of wealth, right? And you can see that playing out right now. My portfolio is significantly higher or larger today than it was in 2019, but yet I'm poorer. Why am I poorer? Because every single time I try to get a reservation at a restaurant, you can't get it. You try to get an Uber. I have access to fewer goods and services today in the United States with a larger portfolio, with more purchasing power, theoretically, than I did back in 2019 with less dollars as far as purchasing power in my portfolio. Why? Because there are more goods and services. You see? So how many goods and services are we going to have when government spending is 70, 80, 90% of GDP? And they say, well, hopefully we just won't get there. No, we have to get there. And the reason is because once you build an economy around QE and around the stimulus and government deficits, you can't pull it back, or else the whole house of cards comes crashing down. Now, they could allow it to do that, which is, and just go ahead and take the medicine. But do you think the cast of characters that we have at the Fed and at the Treasury and in the Biden administration are going to allow that to happen? Absolutely not. Listen, this is straight MMT. The first kind of objective of MMT is when you combine the balance sheet of the Fed and the Treasury. Okay, well, who's the Treasury Secretary right now? Janet Yellen. What was her last gig? I think it was the Fed chair, wasn't it?
Yeah, right. Yeah.
So if you're going to try to combine the balance sheet there to go into this new era of MMT, who are you going to hire? You're going to hire Janet Yellen. And not only that, she is wildly dovish.
Yeah.
And then she's coming out with, she came out the other day and said that that we need to spend a lot more money. The federal government needs to spend way more money, because if you look at their budget adjusted for inflation, it's lower than it was in 2010, as if the budget has anything to do with the amount of government spending when we just ran a $5 trillion deficit. I mean, it was like, how can you say that out loud, that the budget is actually a constraint to government spending? So you have this person that wants the government to spend even more money than they did last year, even more deficits. They want the Fed to monetize it, and she wants the government to be a larger percentage of GDP. She wants tax rates to go up, so they're sucking more resources out of the private sector to be distributed inefficiently by the government. Right? That listen, that's MMT. That's in my opinion, that's where we're headed. That's the highest probable outcome. And I think it takes us right into probably what we talked about on the Endgame series with the central bank digital currency. And then that gets into, and that's where your whole thing comes full circle, because now we're talking about central bank digital currency for a monetary policy, but that takes us into a lot of big brother issues, because we've all got bank accounts with the Fed. And it also gets really scary where they can target lending, who gets loans, who doesn't, and then they can also target interest rates. You see, they can have monetary policy not from a 30,000-foot level for all of the economy, but based on the individual.
Mm-hmm. Yep.
You see, through UBI and through them collecting all of the data, and then basically creating a profile for you that's not really a credit score, but more of a social score. And that's what determines your rate of interest. That determines whether or not you're approved for a specific loan. And that, it just trickles down. It just, I should say, it snowballs from there. And who knows what we're going to see. It could get, and then of course you say, well, George, okay, I'm going to set up a plan B. I'm going to leave the country. And I think it's great to have a plan B. And again, I want to be very clear. I'm not saying that this is definitively where the United States is going. I think if you read, I've got a version of The Road to Serfdom, where Hayek went back and did some comments based on why he did this, what he kind of learned. And one of the things he made very clear is that when you're on the road to serfdom, it's not a foregone conclusion that you get to totalitarianism. That's the road you're on, but you can get off. So I want to make sure that I'm very clear that we can get off this path as long as people are cognizant of what's going on around them, right? But so you've got this big brother situation. They're targeting the monetary policy and the lending, which is very, very important. And then now you say, okay, George, I'm going to have my plan B. I'm going to go over to XYZ country. Right. But what's Janet Yellen talking about now? She's talking about a global corporate minimum tax. And she's saying, okay, 15%, but she even said on record that that's not aggressive enough for her liking. So, once they start at 15, it's going to go up to 20, it's going to go up to 25. It's going to be like the income tax when it started in 1913, 1914. It starts at 3%. Next thing you know, it's 90%. And I think that the probabilities are high that if they institute that type of global corporate tax, I think they're going to do the exact same thing with income tax. Now, are all countries going to play ball? I doubt it. But a lot of the countries in the West, I'm guessing, will probably sign up for that.
Well, a couple things, incidentally, in case anybody doesn't understand MMT, it's modern monetary theory, when you're referring to MMT. And incidentally, it's a theory at best. Now, I think it's going to be proven to be a false theory pretty soon, as far as it being able to sustain. it's a chilling thing when they start talking about, global corporate taxes, et cetera, right? I mean, is there, and I hate to be like the conspiracy theorist, but I've seen too much now not to actually go down those rabbit holes and see where things might go. With this globalization and this wealth grab and the enslavement that it creates. And road to serfdom is a perfect, word for it, because you think about it, more and more money being produced out of nothing, more and more debt racked up. Who's paying this debt? And that's what, and that was my, in my conversation with my friend, I'm just saying, this got to end somewhere. I mean, you can't go on forever. Oh yeah, you can sustain it, and here's how. And I'm like, no, just it defies laws of economics. I'm not talking about theories of economics. I'm talking about laws of economics. It's unsustainable. So it does become very, very troublesome. Now, with that, and I think a lot of the questions that we have are around Bitcoin or around crypto in general, and saying, is this the place to go? So it's been interesting because obviously Bitcoin's down quite a bit in the past couple of weeks, and we always know it's this volatile thing. But how are you feeling about crypto right now?
Well, it's a pretty broad question. You've got a lot of 10,000 coins. So
let's talk about maybe just Bitcoin to start with, and then other coins that you think. I'm invested only in four. I'm not spraying it. Like, I feel like I'd rather get really good and understand four of them than try to track 10 or 20 of them. But tell me what your thoughts are.
I'm just I only own Bitcoin, and I think that you've got to start from a position of portfolio construction. And for every individual, their objectives are different, or they should be. It's not kind of a one size fits all when it comes to investing. So I think right now, the word on everyone's mind should be preservation. So preservation of purchasing power, preservation of liberty, preservation of the way of life that you've come to enjoy and the way of life that you want for your kids, preservation of freedom. And so I think that it's the markets are very not just volatile, but the foundation is built on sand. We know that, and it's all based on kind of this stimulus and the funny money that we were referring to earlier. So I like to just be very conservative and say, okay, I got 10% of my portfolio is in insurance, 80% of it is in investments, 10% is in speculative assets. So I would define the insurance as physical gold. I'm not trying to get rich. You're just trying to maintain your purchasing power. It's done a pretty good job of that over 5,000 years. So it'll most likely do it into the future. And then 80% stuff that pays you to own it. That's how I would define an investment. Because when you have an investment like that, you don't have to get the price right. Because you're not buying it for the price. You're just buying it to pay you. It's just like buying a business, something like that. Buying a McDonald's, buying a Circle K. You wouldn't buy that because you thought the price of the McDonald's was going up and you could sell it for for more money in 2 months. No, you just buy it because it's throwing off $150,000 a year, maybe in cash. And that's an asset that you want to keep in your family and give to your kids for a long, long time. You want to build those assets. That's an investment. Speculation, in my opinion, my definition, is something that doesn't necessarily pay to own it, but there's a lot of asymmetry. And Bitcoin, I think, falls into that category. Now, the issue, I think, just very short term with Bitcoin is how much of the price is dependent upon people who are only buying it because they think the price is going up. And so I own Bitcoin. I wouldn't buy again until I see panic in the market. So I like to buy things when there's panic, and I like to sell them when there's hysteria. And I get that from interviewing and reading my favorite investor of all time, and that's Jim Rogers. So that's not my idea. That's Jim's. And so what would panic look like? Well, panic first and foremost in Bitcoin is going to be when you don't see 25 commercials a day on CNBC. I just went to this Bitcoin conference, which was fantastic, absolutely fantastic. Wasn't really a conference, more like a trade show or a convention. But you look around and you see the type of investor there. A lot of the speakers I have a tremendous amount of respect for, and a lot of them really get sound money principles. But I think a lot of the people that are there participating, they kind of inadvertently are kind of fans of sound money principles. But really, when push comes to shove, they're buying it because they think whether it's GameStop, whether it's AMC, whether it's Bitcoin, whether it's Dogecoin, they don't really care. They just want to get rich quick. And so when I look around, I say, okay, how many of the people that own Bitcoin right now would own Bitcoin if the price didn't change for the next 5 years? 5 years. And what percentage of the people that own it right now would still own it? And what I like to try to do is figure out what price Bitcoin has to go down to where there's an extremely high percentage of people that own it for the sound money principles, and that would own it regardless of what the price does over the next 5 years. That's when I want to buy. I just think there's a significant percentage of people that own it right now that at the end of the day, they don't care about sound money. They don't care about Austrian economics. They just want a quick ticket to get rich or something. They want a lottery ticket, basically.
Yeah, I think that's true. But I think a part of it also, and incidentally, I think that I guess there's two types. I mean, for me, when I bought Bitcoin in the beginning, it was really because I just loved the idea. Morally, I loved the idea of a decentralized currency that wasn't government controlled, et cetera. That I said I'll just invest in that just for the sake of saying I support this as a moral concept. And then of course there's the speculative investor that would say, hey, I think this is going to take. And you hear people talk, oh, it's going to 500,000. It's going to they throw out these huge numbers that they think it's going to go in some period of time. And people, I think, have a lot of FOMO, right? They don't want to miss it. So that kind of gets them in. And then, of course, a hedge against inflation. If the dollar's becoming less and less valuable, then your dollar per Bitcoin is going to go up, so that you're not sitting in cash, you're sitting in something other. So, and I like the idea of how you said, hey, you take a certain minority share of your total portfolio and put it into something like that, which is really
I completely agree. Philosophically, I love Bitcoin. I love the concept of decentralized money. I think that's a much better system, and I'm long term. I'm very bullish on Bitcoin, but I would, but I'm not one of those people, and I really have an issue with the types of people that say that speak about Bitcoin in terms of certainties. That Bitcoin is there's no 99%. There's a 100% chance that Bitcoin is going to be global money. There's a 100% chance that Bitcoin is going to dethrone the dollar. And if you don't believe that, if you believe there's a 99% chance, then you're just too stupid and you don't get Bitcoin. Right. Therefore, you should not only buy Bitcoin, but you should sell everything. You should take out a home equity line of credit. You should, or refinance your house. You should take out all your equity. You should max out every single credit card you have and buy Bitcoin. Because if there's a 100% chance that it goes to $1 million and it's going to be global money, then you're going to kick yourself, in the future for not maxing out every single credit card you have right now to buy Bitcoin. That's what I take issue with.
Well, and rightfully so. I mean, that's irresponsible, right? I mean, you could really be hurting a lot of people by saying those types of things.
Yeah, but a lot of people in the Bitcoin community, that's
Yeah,
that
they're
that's so I like to I like to, I treat Bitcoin like anything else. It's just I like to have a very long-term view, just like commodities. I like to have a long-term view on oil. I like to have a long-term view on copper or uranium or something like that. And so let's go back to 2020 March. I had a long-term view that I liked uranium. Okay, great. So when we had this complete collapse in the market and we had true panic. Anyone that remembers back to 2020 March, there was outright panic everywhere in
yes.
society and in markets, right? So that's a great example of having a long-term view and then saying, okay, there's massive amounts of panic right now. I don't know what the price is going to do in the next 6 months. It could go down another 50%. I don't know. But what I do know is that it's cheap right now, historically speaking, and I do know that there's panic selling.
Yeah.
And if I continue to buy assets in those circumstances and build a portfolio that's diversified around those concepts, that's going to give me an edge. And over the long run, most likely I'm going to come out ahead. And it goes back to answering the question right up front, what is your main objective? And I think for me, and what I would suggest for most people going into very uncertain times, is that their objective is wealth preservation right now.
Yeah, which is interesting. When we talked about earlier about where does money in the world go, and one of the things I had that conversation I alluded to earlier around was the cash glut. Like there's money coming in here from all over the world, because when somebody in Asia or in Eastern Europe or other places, when they have great wealth, this I guess as bad as things are, we're still the tallest pygmy, right? So the money still comes here for protection, which is why sometimes the treasury rate goes under under the dollar. That to say, hey, you give us $1, we're gonna give back 99 cents. They're trying to preserve their money because they're afraid of where it might go or how to protect it. Which way back when in the banks, that's the way it used to be, right? It's like you'd find the bank with the best safe, and you paid them when you made a deposit to protect your money because they could keep it safer than maybe other banks. And it's a scary situation when people have to feel that way. And that's where I think preservation is really the right lens to look through. To say that right now, yes, of course you want to invest, you want to see things grow, you want to hedge against inflation, but preserving is a critical thing. And I guess it has many facets to it, is what how you might preserve. But I think what you described there is important lens to look through when it comes to what to do with your money.
Yeah, and you just you inadvertently opened up a can of worms that I won't get into too much, but that whole yield curve that you're talking about with the treasury market, that's heavily manipulated. Most people, the average Joe and Jane, they think that the only reason an entity would buy a treasury is just to get the yield. That's why you buy a bond. It's just to get the yield. So if you got negative interest rates, then why on earth, or negative real rates,
Right.
why would anyone buy that bond? What they need to understand, and I won't get too far off in the weeds here, is especially the short end of the curve. Most of those treasuries, T-bills, are used as collateral in the repo market. So the reason why entities are buying that has nothing at all to do with the yield, and it has nothing to do with the negative real rate or positive real rate that they're getting. They just want to secure the asset so they can use it in financial engineering, create a derivative, use it as collateral in other markets to make a 5, 6, 7% return, regardless of the negative real rate of return that they have to pay. Also, on the long end of the curve, you've got the Fed monetizing a lot of the debt, therefore creating a lot of excess demand. So it's very the yield curve right now is very, very difficult to figure out. But you're right. Historically, we have been the cleanest dirty shirt, and therefore you've got a lot of capital coming in here, and that's propped up our markets. It's having the global reserve currency. Obviously, we've gotten away with artificially low interest rates a lot longer than we otherwise would have been able to. But there's a lot of moving parts to that, and there's a lot of cross currents. And I looked at a chart that Stan Druckenmiller had the other day, and foreigners are buying a lot fewer treasuries now than they have in the past because of, I think, what you're saying, and that they're looking at this and saying, okay, this has been a safe haven. This has been a quote unquote store of value. It's obviously very liquid. I'm referring to treasuries, but we might want to look for another asset in the future. I mean, if I was a foreign sovereign wealth fund or something like that, I mean, if I had treasuries, see, a lot of them have a mandate to have treasuries as well. But I think gradually, it doesn't happen overnight, but gradually they'll look to other assets to fill that void. But that goes back to a political question. Right now, if the system stays the same, then it's all up to the deficit spending. How many dollars is Biden going to produce with Yellen and Powell? I mean, how many dollars are they going to do it? How much inflation are they going to create? And if they can get the DXY, if that goes down in a disorderly fashion from, let's say, 90 or wherever it is today down to 70 or 60, something like that, I tell you what, you're going to have a lot of those dollars coming right back into the United States, not in the form of dollars wanting to buy assets, but dollars wanting to just get rid of them and trade them for other currencies. They could buy assets. You could see Gresham's law kick in, but you could see a lot of those dollars. That they don't want to hold dollar assets. Therefore, they trade those dollars that they have for other assets denominated in other currencies that could exacerbate the downward push on the dollar. I don't want to confuse people, but the main takeaway there is, if you're trying to preserve wealth, if you're trying to preserve your freedom and liberty and your family's future, unfortunately, you've got to now do more homework than just talking to your financial advisor and doing a 60-40 split, or doing a bond stock split based on your age. That's not going to cut it anymore. I can almost assure you that if you have that type of attitude that people have had for the last 3-4 decades, and that's what financial advice, the Dave Ramsey game plan, let's say, if you have that game plan and you just you're whistling by the graveyard, and I think that over the next 10 or 15 years, unfortunately, you're going to lose a lot of purchasing power as a result. So you've got to set that aside and understand that you need to educate yourself about some things that are rather complex, so you can make sure that you preserve your way of life.
Let's jump into, thank you. Let's jump into a couple of questions. I'm constantly fascinated by you, so it's like I could just want to keep having conversation, ask you questions, because it's very difficult to make economics interesting or fascinating, but somehow you have this unique ability to do this. So, so let me jump into some questions so that we can.
Yeah.
So many people ask questions, so I want to make sure that we honor them and get to some of them. So let's see. I don't know if you'll have a comment on this, but Lynn asked this question. Any thoughts on the possible direction things are going to take in Canada? How similar to the US is Canada?
Well, I don't like what's going on in Canada. I'm assuming that they're referring to a standpoint of liberty. And I mean, look at what they've done during these lockdowns, and look at what they continue to do in spite of all the data that we have in the United States. When we compare states like Florida to California, bottom line is states that have taken very draconian measures with restrictions compared to states that have done, taken a more laissez-faire approach. And we see that the numbers are very, very similar. So in light of that, Canada is continuing to put the pedal on the, last I checked, I haven't done, I haven't heard maybe a month or so, but last I heard, they were really, doubling down and tripling down on these restrictions, and it's turned into basically a police state.
Yeah.
So I know if I was Canadian, I'd be pulling the ripcord right about now. I mean, I would want to get the hell out. And Canadians have a huge advantage that Americans do not have, in the sense that they're not taxed as a citizen, they're only taxed as a resident, right? So unfortunately, US Americans are pretty much the only country on the planet that taxes you as a citizen. So if you move to Singapore, let's say, for the next 20 years, and your tax rate, and you don't make $1, you don't have anything to do with the United States, but you still pay US taxes. You see, where a Canadian, if they move to Singapore for the next 20 years, same exact situation, they would not pay Canadian taxes. They would only pay the Singaporean tax rate. And if that Singaporean tax rate was lower than what they're paying, then they're pocketing the spread. We as Americans do not have an opportunity. There's only one place on the planet Earth where we have that set up, and that's Puerto Rico. For what started as Act 20 and 22, now they call it Act 60. So I'm sure a lot of your viewers know some famous guys that have moved out there. I like to always point out that I went there in 2013, as I was way before Schiff. So don't let Schiff tell you he was the first one. But you got Schiff, you got Harry Dent, Mike Maloney, a lot of good buddies of mine, Yarn Brook out there, and Simon Black as well. So that's kind of the only tax haven, if you will, for people in the US. But again, Canada, I don't know why anyone in Canada, other than, if they have a family, I totally get it, if they've got roots there. But if they've got the ability to kind of look for greener pastures, I would be doing that right now, because I would look at what they had done in 2020 and continue in 2021. And I would say to myself, you know what? I want no part of this. They've shown me their hand, right? They've shown me all the cards they have. They've proven to me that they're willing to go to these extreme measures and turn this into a police state. And so if it's not the cerveza sickness, as I call it, to be YouTube friendly, what's next? What's next? It's going to be something. And another thing, I did a whiteboard video a while back on, and I went back 20 years, and I looked at how many of these virus health scares we had. Obviously, what we've dealt with in 2020, that was not the first. We had the swine flu, we had the bird flu, we had H1N1, we had all of these different things pop up. And what I noticed is in the last 20 years, we had about 10 of them. So roughly every 2 years, we get another something. And obviously before 2020, they were nothing, Americans just completely blew it off, just thought it was something that Chinese have to deal with or something. But now, obviously, that's a lot different. So if Canada has shown you how they're going to treat you in 2020-21, what happens when we have the next XYZ virus in 2024? That's pretty much most likely going to be their standard operating procedure. And again, I would want nothing to do with that. In fact, I would be thankful that I was able to see the true colors of the government and how authoritarian they are, while I could still get out. That's kind of how I'd be looking at the situation there.
Yeah, it's to your point. I have wealthy friends from Canada that are in the United States right now and can't and won't go back, because of how draconian it's become.
Don't blame them.
So I would love to see a bunch of wealth come from north of the border and flood in here. If you're welcome, but just make sure you go to the right places.
Yeah.
All right, so there's another one. So this is, and Sharon asked this question: are we going to? are we going to get to what to do about all this, or just discuss the problems in the world right now? So I think, I'll just start and say this, but I think we are trying to discuss what to do. I think the gravity of the problem needs to be discussed because that's what motivates people to take some action. But we're also saying, here's what you can do, or what positions you can take, or what things you need to think about. I mean, the whole series was about that, quite frankly,
Yeah.
what you can actually do. But is there anything that you think is important that we should do that we haven't been discussing?
Well, we talked about owning gold and silver, some precious metals as a hedge. And again, it's not to get rich, it's to stay rich, or, said another way, just to maintain your purchasing power. I think another thing from a financial standpoint that pretty much everyone can do is if you have a mortgage, whether it's on a rental property or your own home, make sure it's a 30-year fixed rate mortgage because that's a short position on the dollar. So if the government over the next 10, 15 years succeeds in achieving a 1970s type of inflation to lower the debt to GDP, what does that do to your mortgage? If the debt to GDP goes down as a result of inflation, the value of your mortgage, or the value of the dollars that you're paying your mortgage back, decrease. And not to get real technical, the bottom line there is that is a transfer of purchasing power from the lender to the borrower. The borrower would be you, because you're paying that back with cheaper dollars. So the bottom line is your mortgage payment stays at $500 a month, let's say, but your income, hopefully if it goes up with the rate of inflation, goes up and up and up and up and up. So that mortgage occupies a lower percentage of your monthly income. Right, that's how you're paying it back with cheaper dollars, you see. So that's, I think, something that everyone can do. I think every American should have an RV, and just park it in your driveway, for heaven's sakes. They're cheap. In fact, for my viewers, I suggested that a few times that they get a specialty RV, maybe a little Shasta that's been remodeled, or an Airstream. And why do I say that? Because then you can cash flow it. Because you can rent it out on Airbnb if it's parked in your. Now, I'm not saying people drive it away, but they use it as like a hotel room. And I actually, when I came back, when I first got to Florida, I stayed in an RV park that someone was renting out on Airbnb, just to prove my point. And this RV, the guy, it was a brand new RV, but it was maybe 25 grand he paid for it, right? It wasn't anything real fancy. It was just new and clean. I was paying $150 a night for it. $150 a night. And so think about that at an 80% occupancy rate. And if you're $25,000 out of pocket, that's a staggering return. That's unbelievable cash flow. But yet, that's also your plan B. So if it hits the fan and you don't like what's going on around you, if we have riots or looting like we had in 2020, great. You can go ahead and just load up your RVs right there in your driveway, take it off Airbnb, throw in the kids, the wife. You got a nice diesel truck right there. Go up to the mountains and let things just settle down and watch it from a distance. That's another just real life thing that I think almost everyone watching can do. And it's kind of a no-brainer.
I love that. I hadn't heard that before, and I love that idea. Because you're right. I didn't even consider that if you had one and it's parked, it can become a cash flowing asset. It doesn't have to just sit there, doing nothing. But it's also your fail safe. You need to get out of town, you need a place to sleep. There it is. Just hook it up and go.
You got it.
I love that. That's genius. All right, let's grab another question here. All right, so David asks, predicted economic forecast for June, July 2021, commodities, gold, equities. Do you have any thoughts around that?
No. I really tend to, if I'm doing a whiteboard video, they're usually thought experiments, or I'm trying to explain someone's view, or I'm trying to explain something that's complex. I don't like to make predictions because I just like to fall back to just its probabilities. And whenever I'm investing, I don't start from a position of what the price is going to do. And I think that's a big mistake that most people make. So usually they're like maybe this person, and it's a great question. I don't want to downplay the question, but I would never say to myself, okay, let's see, I'm thinking about buying oil. What do I think the price is going to do over the next 2 or 3 months? What's the price going to do? I would never, ever, ever start there. Where I start is asking myself the question, is it cheap or is it expensive? And if it's cheap, I buy it. If it's expensive, I sell it. If I don't really know it's kind of the middle, I just hold it. I don't do anything. And then I try to wait for the panic, and you set up that list of assets that you're kind of your watch list, if you will. And then you keep track of things. But that's where I think most people would do a lot better over the long run if they started with the question, is it cheap or is it expensive? Historically speaking, when you adjust for inflation, looking at commodities,
Yeah.
there's other ways to measure stocks, obviously. And then kind of ignore, what's the price going to do? Another great example I would give to kind of illustrate my point is back in March of 2020, I bought, and this was when oil was about, I think it's getting down 25, 20 a barrel, something like that. And I knew that because I had studied it a lot and I was kind of long-term bullish on oil, that when oil gets below $30 a barrel, adjusted for inflation, usually that's pretty cheap. It's gonna revert to a mean there. And generally when it gets above 80 or 90, it's getting pretty expensive. So I always thought to myself, okay, I'm a buyer at 30 and below, and I'm probably a seller at 80 and above. That's how I'm going to define cheap and expensive. So when it got down to 25 and 20, again, this was massive panic. And remember when the futures market was trading at like negative $40 a barrel. And I mean,
People
just
didn't want to get delivery. Yeah.
yeah, unprecedented stuff. And I honestly thought that if I had to just kind of bet money, I would have thought that oil would have gone down to probably 10 a barrel. And so the moral of the story is I didn't wait until oil got down to 10 a barrel. I started buying at 25, even though I thought the price was going lower.
Right.
Why? Because it was cheap. You see? So again, if you start from that question, I think that over the long run, you're going to make better decisions based on the probabilities, and you're going to have a mathematical edge. Because, if you read the Market Wizards books, which I suggest everybody do, you learn from the legends like Druckenmiller and my favorite, Jim Rogers, we talked about him earlier, and all the greats, back in the 80s and the 70s and whatnot. And you learn that you've got to have an edge to do well. So if you're a retail investor, you've got to look yourself in the mirror and say, what's my edge? Well, what edge do I have over Stan Druckenmiller? What edge do I have over, David Einhorn or any of these guys that you see on CNBC or Carl Icahn, or, what edge do I have on just the other retail investor that's trading on Robinhood? And if the answer is you don't have one, then you're gambling. You're not investing, and you might as well take your money and go down to the roulette wheel or play a slot machine or something like that. So my point is, if you're able to look at a market and make decisions in a way that nobody else is doing, and that's cheap and expensive instead of which direction the price is going, I think that gives you at least the start of an edge. And if you got that edge, then I think at least you're not gambling.
At least. That's
right.
Awesome. Listen, I really appreciate you doing this tonight. For all of you, I know there were more questions, and I think in the course of our interactions, we answered a lot of questions as I was scanning through them.
Okay.
So we did really well there, and then we picked up a few more at the end. One of the things I just want to remind everybody is that we're still in the free viewing period for Endgame. You can still get it at steep discount, bonuses, etc. I think right on the page where you're viewing us down below that, you'll see what's there. So if you haven't already, first of all, if you have already invested in game, thank you. We really appreciate it. It encourages us to keep doing this work, and it's been a real pleasure with this audience. I mean, they're really enthusiastic about the materials, so thank you. And if
Yeah.
you haven't invested yet, now's we're coming right to the end of the previewing period, so now's the time to do it. George, I just really appreciate, like I said, I'm fascinated by it. I could sit and listen to you like no other people who like especially talk about macroeconomics. I don't know how you got this gift, but it's amazing how you're able to take these concepts, translate them, speak to them with authority, make it fun, and then at the same time also give some what I think is really sage advice. So you're quite a unique individual, and I really appreciate all the value that you deliver to this audience. A lot to us. Thank you.
Thank you. Thank you very much for the platform, and thank you very much for the kind words.
So, and I know you've got you're traveling around doing some live events, so have some fun there. Imagine that in this COVID world, live events. I think it's a beautiful thing. People getting back to some semblance of normal life. And for you who are watching, again, appreciate you so much. Thanks for being here. Stay on the lookout. We're gonna keep sending great information your way, and as we come across new stuff that we think you need to know, we're gonna get it to you. So with